horrific losses. Our next guest says the market will miss them. He's Kyle Bass, who in his long career in asset management has focused on companies he believed were overvalued and in many cases, Kyle, even frauds that you helped to potentially uncover. Let me start, though, with the simple question. Is short selling, as we've known it, dead?
I mean, I don't want to be hyperbolic and say it's dead, David, but you and I have known each other for the better part of 25 years, and things have evolved over time. You have the Fed printing an unprecedented amount of money. You've got retail traders, getting together and kind of laser focusing on companies, and so I think the risk profile of being a short seller has dramatically changed, and I think that the one negative consequence that I see coming out of all of this is the fact that short sellers are a natural balancing force in the market. Many past and current chairpersons of the SEC have said so. And so the work that's done in the short selling community to police the market of frauds and Ponzi schemes and deceptions by management, I think is a very positive balancing force. And unfortunately, what the most recent events are going to precipitate is the fact that short sellers, many of them are going to walk away and not do the work that they used to do over the last few decades.
Yeah, you mentioned, of course, our long friendship. We date back to a company called Arrakis Energy in 1995, Kyle. And there was a series of companies from the late 90s and onward that you focused on in terms of doing work at that time, that reporters also focused on, because you did feel that there was something wrong or that there was actually fraud in terms of what they were representing. Explain to people what short sellers, in those cases at least, were capable of doing and why that was a benefit to the market.
I think when a short seller finds a fraud, finds where there could be tens of thousands of individual investors, typically frauds are perpetrated not on institutional investors, although they do get caught up every now and then in frauds unwittingly. But I think the majority of the frauds throughout my almost 30-year career on Wall Street has been taking advantage of mom and pop, taking advantage of people just trying to earn an income on their retirement savings, or just trying to grow their portfolios slowly because they're not financial market geniuses. They're not people that spend all their time in the market. So, you mentioned Arrakis Energy. If you remember, that was a company, a Canadian listed company. It was also listed in the US that was telling people that they had one of the largest oil finds in African history in the Sudan. And the company built up to over a $700 million market cap. And when I got a hold of the Chevron project manager that sold Arrakis Energy the oil lease for $1 million, he said there's no way it can work. They'd have to heat up the oil at every 300 feet for 400 miles to get it to the coast. So these frauds end up sucking in so many individual investors. And we can go through the list of frauds in the big ones, the Enrons, the WorldComs, the Wirecards. Most recently in Germany, in Wirecard, they put the whistleblower in jail before they realized that he was right. And the whole thing was a fraud. So it's very important to have this balancing force out there to keep the investing public out of being defrauded of their precious retirement savings.
Shepard Smith here. Thanks for watching CNBC on YouTube.